the first part about the basis of technical analysis, the theory, and the second part about some applications on some pairs such as the euro-dollar, cable, dollar-yen, etc. We will finish with your questions if you have any. So let's start with some words about the trading control, which is providing this webinar to you today. Trading Central is a technical analysis company founded 15 years ago and has some office in Paris, London, New York, and Hong Kong. We have registered in Europe, Asia, and the US for many years now, and a certified member of Investor Side Research Association. We have many clients, more than 100 all over the world in 35 countries, and we are very proud of our well-known clients such as Barclays, UBS, Deutsche Bank, Morgan Stanley, etc. So today, I will host this webinar for you today. My name is Christophe Chagui. I'm a technical analyst at Trading Central, specialized on the forex market and fixed income. I've been working there for many years now, since 2007. Before attending this job at Trading Central, I was a FX trader at EDF and equity sales at ING Wholesale Bank. With a broad definition of technical analysis, technical analysis is based on market players, the psychology, and not on figures such as revenues, net income, etc. And it focuses on price evolution itself and not the reason behind the evolution of the prices. For example, we don't care about the reasons why stock or pair is rising or falling. We only focus on the actual performance of the price and not on the reasons behind these evolutions. And technical analysts also believe the past performance of prices and markets moves are indications of future performance of this moves. So we believe that in some way history can repeat itself. Some words about the origins of technical analysis. Many of you surely have already heard about Dow Jones, for example. And Charles Dow was is considered as the founder of the technical analysis. He's an American journalist and also founder of Dow Jones Company and the Wall Street Journal. He was born in the middle of the 19th century. And his theories remains the foundation of technical analysis until now. So this is quite important that this definitions remain in place more than a century after his death. Let's now see some basic tenets of Dow theory which are still in force now. First of all, the market discounts everything. This means that we believe that prices are most important as the reason why the prices are moving. We can find three trends: up, down, and sideways markets. This is very important for you in when you invest in a forex market, for example. You can take advantage of up market, down market, and sideways markets. And also a very important one, the trend remain effect until clear reversal occurs. This means that you should trend within the trend as much as possible, following this motto: trend is your friend. Let's switch to this one. Some words about our methodology here at Trading Central. We will study this more deeply in the coming slides. First of all, charts analysis, which is first of all identify trends, as I previously said, to try to trade a given trend. Find some channels, supports, resistances, patterns. We'll study some continuation patterns and reversal patterns when the trend is reversing down. and with some technical indicators such as RSI, MACD, and moving averages. Now let's have a look at trends. As I said, trends are most important to follow. You can notice the three kinds of trends: the uptrend, the downtrend, and the trailing range in the middle. The uptrend can be defined as a successively higher peaks and higher through. As you can see here, the trend starts at the bottom left and ends at the top right. You can buy on the through and sell on the peaks. You can see the trend is obviously on the upside and this way from here to here. Get the exactly opposite for the downtrend with a successively lower peaks and lower through. Peaks here, here, and here. You can see they are lower. The same for the bottoms, which are also on the downside. And the third one is the trailing range, which could be very important to define in a forex market, for example, because maybe you have noticed that on a intraday basis, forex market are very often trading within a range. So you can, if you notify this trading range, you can buy and sell. See the opposite here, you buy at the bottom and sell at the top. So price are moving sideways between resistance and support. We'll see more about resistance and support in the next one. Here you have an example of trends. You can see here the downtrend when the successive peaks are lower than the previous one. Here you have an uptrend. You can see also peaks are higher and higher, with bottoms also higher and higher. This is an uptrend, and then we finish with a new downtrend. Let's now look to channels, which are quite similar to trend. You can notice we have three kinds of channels: ascending channels, descending channels, and range. They are very similar to trends we saw previously. So in the case of an ascending channel, you can have a successive higher peaks and higher lows, such as a trend. And it means the trend will continue on the upside. So when you notify the lower boundary of a channel, you can buy on each pullback of the prices and sell on the upper boundary of the channel. Or maybe if you buy at the beginning of the trend, you can hold your position and sell here, for example. Or if you're more likely to trend very often, you can buy here, sell here, buy here, sell here, etc. This is the exactly opposite for in case of the descending channel, with a continuation of the downtrend, the successive lower peaks and lower lows. You can see on the upper boundary lower peaks and the lower boundary lower lows. So you sell here at the top of the descending channel, and you can buy at the bottom of the descending channel. In the third case, in the case of a trailing range, prices are moving within range boundaries. In the case of a sideways market, you can buy on the bottom and sell on the top, and take advantage of this trailing range. Here you have an example of a bearish channel. You can see very easily here the upper boundary and lower boundary. So you can identify this channel around here, for example, and then you can start to sell here at this point and buy back maybe if you are in a hurry to play the recovery before a new down move. And when the upper boundary of the descending channel is broken here at this level, you can enter a long position to take advantage of the new uptrend. Let's now speak about supports and resistances. You can very often hear about these supports and resistances. So what are they very concretely? You can see on these charts that buying and selling decisions are partly due to psychological reasons, as I mentioned earlier, so, following Dow theory. So the level is considered as a support. In this case, here you have a support. If every time the pair of the stocks try to break below this threshold, the stock does not achieve this break and rebound above this support. So when you see here 3 times, try to break a level, but we failed at each time. So this level here will be named the support. And this is the exactly opposite for resistance. In this case, you see the prices are changing this price here, this horizontal resistance, and fail in each case to break above this level. So this is a very relevant resistance, and we'll see that the more you have some rebounds, or in this case, for example, the most relevant is the resistance of the support. And the aim of these resistances and supports is to highlight some intervention levels. So in the case of a support here, you can buy on this point or on this point. You're very confident on your trade, because this support seems to be very strong, and if you buy at this level, you can set your stop loss just below the entry point and have a nice risk reward, as your stop loss will be very, very tight, and your targets will be at a higher price. So to determine stop loss, and very relevant to manage your positions. Some words on pivot points and stop losses, which are very important to survive in the long run on the financial markets. So this is the key technical levels, which could be a support in case of a long position, or resistance in case of a short position. When will you turn bullish from bearish, or bearish from bullish? This is some kind of stop loss level. For example, if you buy a stock or a pair, you set your stop loss just below the support, and if we break below the support, you will turn bearish on this position with no regret. You will see, okay, I made a mistake, I'm wrong. This is a normal buying opportunity. This is became a short opportunity. So I cut my loss, and I enter a new short position. The purpose of a pivot point or a stop loss is to have a very tight, is to suffer very tight losses in order to enter a new position and get some great earnings from another targets during another target. In this case, you can see a nice example with a nice support here. You can see from these 2 previous rebounds that the third one could occur. You open a long position here, and the prices goes up. You set your stop loss just below, and you can raise your stop loss from time to time if you're willing to. And when the stop loss when the prices closes below 130, which is your stop loss or pivot point, you catch your position, you take your loss, which is a very small loss, because this support was very well drawn. So you catch your position, you take your loss, and then you enter a new short position, which will be of higher performance than the previous one. So you have a very tight loss, very short loss, and a huge gain when you reverse your position. So in this case, this support was very relevant because you can earn money by buying at this stage, buying here also, and then you can also win some money by cutting your position very quickly when we break below the support, open a short position to take advantage of a new downtrend. Now we have a look to some patterns. We start with continuation patterns. We also can find reversal patterns. So let's start with continuation patterns. In this case, continuation patterns are very useful to trend within the trend. To follow the motto, trend is your friend. So let's start with triangles. You can see you have 3 kinds of triangles: ascending, descending, and symmetrical triangles. Ascending triangle is seen during a rising trend. The trend is this way and will resume this way on the side. You can draw your triangle following these basic rules. You draw an upper boundary of the triangle, the lower boundary of the triangle, which is a rising one, and you can find the targets by projecting the base of the triangle, which is here. Projecting the base, and you get your target here. So triangles are very useful, as mentioned earlier. You can trend within the trend, and you can buy here. When we break above the upper boundary of the ascending triangle, this means the triangle is validated. The trend will resume in the upside. So here you set your stop loss just below, and your target is here, given by the base of the triangle. So what is very useful in this kind of pattern is the stop loss is very tight, just below the upper boundary of the triangle. The target is very clear because it's been given by the projection of the base of the triangle, and it gives you a nice risk-reward ratio, as the stop loss is very tight in case if you are wrong, and the target is very high. So if you lose, you lose just a little bit, but if you win, you will win much better money, much more money. This is the exact opposite for a descending triangle. This in the case of a bearish trend. The trend is bearish on the downside. Is shaping this triangle. Prices are consolidating on a hold move, and when we break below the lower boundary of the triangle, the bearish trend will resume on the downside. And the same case as the ascending triangle, we can buy here. When we break below the lower boundary of the triangle, you set your stop loss just above this upper boundary, and your target is given by the projection of the base of the triangle. So a tight stop loss, nice target, and that's all you need to be profitable in the long run. The third case is a symmetrical triangle. You can see this kind of triangle in a bullish trend and also in a bearish trend. So when the trend is bullish and you see this kind of triangle, means when we break above the upper boundary of the triangle, the trend will resume on the upside. And if you draw this kind of a triangle in a bearish trend, this means when you see this triangle, the trend will resume on the downside when we break below the lower boundary of the triangle. And here, the objective, the target, will be the parallel projection of the lower boundary, in this case, or upper boundary in the bearish trend. So you take this lower boundary, you make the parallel to get your targets here. So very useful also to get a stop loss and a very relevant target. You can see in this example, nice triangle. the trend is on the upside, prices are moving sideways from a couple of weeks, and then we break above very sharply the upper boundary of the triangle, and the uptrend will resume on the upside. Target is set by the projection of your triangle. You set your stop loss just here, and you get a nice reward. Let's now have a look to some others continuation patterns. Flags, which are very relevant, especially on intraday basis and Forex. You can see many flags, and they are very powerful patterns. So there are also continuation patterns. This means you will trade within the trend. For example, the trend is on the upside in case of a bullish flag, and it will resume on the upside. In the case of a bearish flag, the trend is on the downside, and it will resume, and then the flag on the downside too. So you can see here the prices are fluctuating within the two boundaries. A bullish flag you can see as a downtrend slope, a slight down slope, but this is a bullish flag because the trend is bullish. So you target this kind of patterns gives you a nice stop loss just below the upper boundary, and gives you also the target, which is a flat pole of the flag in case of a bullish flag, and also in case of a bearish flag. In this case of a bearish flag, you can sell here when we break below the lower boundary of the flag. Set your stop loss just above this lower boundary, and you get your target by the flag pole, projection of the flag pole of your flag. The target is a nice one, while your risk reward is very high, as your risk is tight because your stop loss is set just above your entry point. Let's now switch to reversal patterns. When the trend is coming to an end, you can take advantage of this reversal trend by finding some reversal patterns. We see two kinds of reversal patterns, double tops and bottom, and also the head and shoulder pattern. We'll start with double bottom and double top. Double bottom, the first one is used when you the bearish trend on the downside, and this pattern is taking shape, and a new trend will take place on the upside. So this is a reversal pattern. You can take advantage of these patterns to enter a new trend. And this is the exactly opposite in case of a double top. Here you have a bullish trend, the double top is taking shape, and then the bearish trend is taking place. So you have some rules to validate this figure. Second peak is slightly weaker than the first one. You have balance of two peaks in time and amplitude. You can see on these charts. Neckline of a weak slant, very weak slant. So in this case here of a double bottom, you can buy here when we break above the neckline, or you can wait for a pullback. Sometimes you have a pullback on the neckline. It's not always the case, but for the latecomer it could be useful to wait for the pullback. You set your stop loss just below the neckline, and your target is set by the height of this double bottom, which is a projection tool. So you have here a tight stop loss, a nice target, and your risk reward is in this case very interesting, at least 4 and 5. You can see higher target and a short stop loss. And this is also the exactly opposite for a double top. In this case, you can sell here or wait for a pullback in case you are a latecomer. You set your stop loss just above the neckline, and your target is set here the projection of the height of the double top. Have a tight stop loss and a nice target. You have an example here. For the double top, here, the second peak is slightly weaker than the first one. You have some slant of the neckline. You can sell here, just here, with a stop loss just here above the neckline, and your target is set by a projection of the height of the double top, which is here in this case. But in this case, it fell much deeper, and so it would have been very successful in this following this kind of pattern in this case, because the targets have been rapidly hit, and you can in this case you can set your stop loss, lower your stop loss. For example, if you enter your position here with your stop loss here, you can lower your stop loss when you are pushing to your targets to take advantage of the new trend, and lower from time to time your stop loss until you're hit. But your stop loss is hit in a beginning mode. Now the second kind of reversal pattern, very well known, head and shoulder patterns. So two head and shoulders, regular head and shoulders here, and a reversal head and shoulders here. Head and shoulder are very useful in case of a bullish trend here. You can see this pattern is taking shape, and then a new trend will take place on the downside. So we have some rules to validate an head and shoulder: 3 consecutive tops and lows. Here, and 3 rules to validate these figures. 2 shoulders should have similar amplitude. You can see here shoulders, and the balance between head and shoulders in time and amplitude is the same kind of rules as double tops and bottoms, and the neckline with a 3 weak slant here. So you recognize here the head and 2 shoulders. That's why we call it the head and shoulders pattern. And the same kind of scenario could apply on these head and shoulders, such as a double top. For example, you can enter a short position here, or wait for a slight pullback. Set your stop loss just above the neckline, and your objective is given by the height of the head of the head and shoulder patterns. You can project this target, and it gives you your objective. This is the exact opposite for reversal head and shoulders. In case of a bearish trend, which will turn into a bullish trend. So when you identify your reversal head and shoulders, if you have head here and 2 shoulders, you have your neckline here. When you validate your reversal head and shoulder, you enter a long position here with a tight stop loss just below the neckline, or you can wait for a pullback if you are a latecomer, or if you missed the first break of the neckline. You can enter a new long position here if your stop loss still below the neckline, and your objective is given by the height of the head of the reversal and shoulder patterns, with a nice objective which is much higher than your stop loss. So it will be profitable in the long run if you follow these rules with a tight stop loss and very long objectives. The risk reward will be good, and will survive the financial markets in the long run. So let's have an example of this reversal and shoulder pattern. In this case, you have a bearish trend. This head and shoulder pattern, reversal and shoulder pattern is taking shape with the head here, shoulder here, here. You can draw your neckline here and enter your position here. When we break above the neckline, you set your stop loss just below the neckline with a high stop loss, and you get a very nice objective, which is set here, and we hit the objective, the target, very easily with a slight pullback. If you want to enter a new long position, for example, for the latecomer, you can enter a position here, and this is a slight pullback with a stop loss here, and your target is much higher than your stop loss. You can see target is here, and your risk is here. So you can see you have for a risk of 1, you can win at least 3 or 4. So this risk reward is very, very relevant and worth. Let's now speak about some oscillators, which are very well known, such as the RSI, which is a relative strength index, which is an oscillator used to recognize the maturity and the price, if the price is weakening. So the advantages of the RSI are to identify if the trend is facing a reversal. Could be combined with the other chart pattern we've seen just before, such as head and shoulders and double tops and double bottom. The RSI is drawn here at the bottom of this chart. You can see here it looks like the trend, but with a smoother line. It is limited between 0 and 100, 0 and 100, and you have this formula if you want to learn it, but it doesn't. It's not an obligation for you. The most important is to understand that the RSI is useful to recognize if the maturity of the price is still in force. And what is very useful in RSI is to find overbought and oversold areas. When the RSI is above 70, you means that your trend is overbought. And when the RSI is below 30, it means that your trend is oversold. So when your RSI is above 70, in this case, for example, you can ask yourself and wonder if the price will go up more and more in the future, because maybe because of this overbought area, maybe the price is weakening. So it doesn't mean that the trend will reverse down, but maybe the trend will have the price will have a pause, will not rise at the same pace it used to be. So when you see that the RSI is above 70, it means caution. Be caution when your RSI is above 70. And the exactly opposite, when your RSI is below 30, don't sell when your RSI is below 30, because it means that your trend is the bearish trend is weakening. So some words as a conclusion before analyzing some pairs. So to sum up, technical analysis is a decision-making tools. It can provide buy and sell signals and trading ideas. It is complementary to fundamental analysis. We are not an enemy of fundamental analysis and news sources. We are complementary to these fundamentals. What is to be reminded is that prices reflect all the information available on the market. It may predict future movements before the relevant news comes out. It can also be applied at different maturities, such as intraday or longer term. And also technical analysis can allow you to take advantage of up, down, and sideways markets. So I will now show you some example. I will share my screen with you. So you can see here euro dollar on a daily basis. This means that each bar chart is a day. You can see here March 2013 on the left, and we are here in 2014. So what can we see here? You can see here I've drawn a pattern which is called falling wedge, and this is the continuation pattern. I set the stop loss here at 1.33, which is the previous low of the market, and also hit at several times in the past in 2013, here. So this is a very nice support. I set another support at 129.90, which is here on a horizontal support too, which has been hit here in the past, in April, in June and July, and another support at 127.50, which is a previous low of July in 2013, which has been hit also in March and April. Targets on the upside are set at 139.70, which is a nice horizontal resistance. You can see here, the one here. And the second resistance, second target is set at 132.35, which is a previous stop of November 2011. And the third target at 145.40, which is, you can see here, a nice resistance area from summer 2011 too. So what I will recommend is to be long on the euro dollar, to buy euro dollar, especially as we validated this continuation pattern, falling wedge pattern, which calls for a further move. So above 133, further advance is likely on the euro dollar. Let's now have a look on the cable, which is British pound versus US dollar. In this case, you can see that the trend is on the upside, so we'll try to buy each pullback because the trend remains on the upside. You can see here the RSI is around 57 above the neutrality area, but it is not overbought and not oversold, so we remain on the upside. You can notice here a nice continuation pattern, which was trading range. It lasts from September to November last year. So when we break above the upper boundary of this trading range, we can enter a new long position with a stop loss, a very tight stop loss just below the upper boundary of this range, and you take advantage of the move, or you can wait for a pullback here and enter a new position. The stop loss set just below this neckline, and the prices goes up also and touch this resistance at 166.70. I set another resistance at 170.40, which is a previous stop of 2009, and a third one at 174, which is a previous overlap of 2008. So you can notice a very strong support here. We can have also a nice one here below the previous range at 158.70. And we can raise the stop loss here from now on to 162. So above 162, the price will remain on the upside. And if we break below 162, we'll come back to 158.70, which is the lower boundary of the previous trading range. Now let's turn to dollar yen, US dollar versus Japanese yen, which has been following a very strong upper bullish trend in the past months, and which has validated a nice triangle pattern, as I should shown you some the theory in the PowerPoint. Now you can see the reality, a nice continuation triangle patterns on this pair, which has been validated In November of last year, when we broke above the upper boundary of this triangle, you can set your stop loss just below the upper boundary of this triangle at around 99 and take advantage of this move. You have a slight pullback here. In late November, you can take advantage for the latecomer of this pullback to enter a new long position. And the targets of the triangle is set by the projection of the base, by the projection of a base of the triangle. So here around 107.50, which is not hit yet. Prices are facing a pullback, currently a pullback towards their new support. As I told you earlier, you can raise the stop loss from time to time when the prices are going on your way. In this case, if you set your stop loss here when we break above the upper boundary of the triangle, you can raise your stop loss from time to time to take advantage of this trend, and then your stop loss will be above your entry point, and you won't lose any money if you hit your stop loss when you have raised, since you have raised your stop loss. In this case, I will suggest to enter to remain long on dollar yen above 130, and as the vertical target of the triangle has not been hit yet at 107.50. So I will remain long above 130 to catch 107.50 at first, and then 110 and 50 in extension, which is August 2008 top, and 115 in extension 2 as a third target, which is December 2007 top. Maybe I have some 3 minutes left. I will have a look to some other pairs, such as Aussie dollar, which is the Australian dollar versus the US dollar. You can see here a bullish trend, which is currently a downtrend. You can maybe shape here a head and shoulder pattern with the head here, shoulder here, left shoulder, right shoulder here, left shoulder here, and you can have been entering a short position when we are broken below 92.75 here. Set your stop loss just above this threshold, and take advantage of the downtrend, which is still in place. So following this reversal pattern, we can enter in a short position, which is still in force. And we have broken below a nice support some days ago, around 88, which confirms the bearish trend on this pair. So for the moment, I will remain bearish below 92.65, which is a previous neckline of this head and shoulder pattern, with a nice support at 85.70, which is a previous bottom here, horizontal support. The second target at 83 here, from the bottom from 2010, and the third one at 80.60, which is here, a nice bottom too. And if we break above the former neckline to 92.65, we'll turn bullish with a first alternative target at 95.40 here, nice horizontal resistance, the top of the shoulders, and the second alternative target at 97.60, which is the top of the previous head, of the head and shoulder pattern. Previous top of October 2013. So that's all for this presentation. I guess I have 45 minutes. I'm waiting for your questions, if you have any questions. If you have any questions, I'm waiting for them. About presentation or the analysis on the pairs. If you have any questions, you can write them on the chat box. So I have a questions about the RSI. Someone is asking if the RSI is enough. No, the RSI is not enough, but it gives you a clue to check if the trend is still in force. For example, if you are a buyer, and if the RSI is overbought, in this case of buying position, it means that you should should be aware that the trend is weakening. Does it mean that the trend will reverse? But the trend may be weakening, and is not the good time to enter a new long position, and you can wonder if you will keep your previous long position. So this is a warning signal. RSI is a warning signal, which is a warning for you, and cannot be used as itself. Don't choose only the RSI to enter or exit positions, but the RSI is a complementary tool. Is a tool, a side tool, which is useful to give you some warnings. So another questions about Fibonacci points. Indeed, Fibonacci levels are very useful tuning, especially on Forex and intraday trading on Forex. But this is a subject for an advanced level, and this maybe you could have some. We can speak about Fibonacci theory in next webinar, but this is not the purpose of this one because this is a very basic webinar. So maybe in the future we will have a webinar about Fibonacci. I have another question. How can I make use of these patterns when it needs time to calculate these patterns? Why the market won't just wait for me? Indeed, it depends of your time frame. For example, if you're using these patterns on a midterm analysis, for example, as I shown you, euro dollar, cable, etc., dollar yen, I show you some patterns on a daily basis. So these patterns are relevant for a long time. On the dollar yen, for example, triangle that I shown you is still relevant. So of course, if you're trading on a very intraday basis, this pattern will be hard to assess, of course. But if you're trading, for example, using 30 minutes charts, if you enter a position for the next 2 or 3 hours, I guess you can draw your patterns very easily, and the market will not wait for you, but you will have time to make this analysis before entering your position. I guess this is also a question of habits. When you'll be used to these patterns, you will be faster to draw them and to use them. And this will be very relevant, and in my opinion, more relevant than if you don't use anything. There's another question. Can we? Is there a certain indicator works better with certain product, or can I apply one indicator for everything and it should give me the same level of success? Indeed, you can use an indicator for every kind of product and every kind of time frame, intraday or to medium term analysis. But as I told you before, when you're used to trade, you can notice that certain kind of pattern are more relevant than others. And I mentioned in this webinar the most relevant patterns, in my opinion. And I told you that flags were very useful for intraday analysis on Forex, and I believe so. Channels are also very useful on intraday analysis on Forex. And this kind of patterns are also very useful for equities in the medium term, for example. But you can see many of them, I say flags and channels, in the intraday analysis on Forex. And this is very relevant because many traders are following this kind of patterns. So in my opinions, flags, channels, and triangles are very relevant patterns on intraday analysis, especially on Forex. Can we use RSI to identify a possible breakthrough? Yes, we can. As I told you, RSI is a tool you could add to your analysis, but RSI is not relevant by itself. So when you see, for example, that RSI is overbought, but you also see that your prices are broken above resistance, you can say that this overbought situation is quite normal, because we have broken the resistance. So when you break above a resistance, you face an acceleration, a sharp acceleration of your prices, and in this case the RSI will be overbought. But as you can see, that doesn't mean in this case that you have to be caution on this trend, because the break above the resistance opens the way to a bounce. So, for example, when you have prices are trending within a range, the RSI will be also around 50, and if we break above the upper boundary or lower boundary of your trending range, the RSI will be very quickly overbought or oversold. But in the case of a break above a trending range, it doesn't mean caution, because it is normal that the RSI, which was used to be within its usual boundaries, will break in the same way as the underlying. So in this case of a breakthrough, you don't have a close look to the oversold or overbought area, because they are less relevant than during the normal, I will say, evolution of the prices. Okay, if you have no more questions, I guess we can put an end to this webinar. I hope it was very useful to you, and I wish you a very nice day and a very profitable trading in the future. Thank you all for your participation.